Hey everybody, Dave here, Hidden Freedom, and welcome back to another Saturday video. Glad to have you back. If you're new here, please consider subscribing to the channel. I don't ask anything of anybody. This is free content. There is no Patreon, and I'll never do a Patreon. I just don't see the purpose of it. But you can support me by just subscribing, and I'd appreciate it. So what we're going to talk about today is a concept that I came up with to kind of illustrate all the different types of ETFs out there. So we're talking about just the index ETFs or dividend ETFs or income ETFs and all that. And this kind of illustrates it, in my opinion, a good way to kind of look at these based on possibly your age and your particular requirements, risk tolerances, and possibly even your income requirements and stuff like that. So this is relevant to my portfolio, which we will look at near the end of the video. So let's go ahead and get started. The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. All right, what we're looking at here is a blank ETF investment pyramid. Like I said, this is a concept that I came up with one day, and it's based off of the food pyramid. I was going to actually do ETF food pyramid, but I didn't want people to get confused, and I didn't want the YouTube to get confused and try to look up food pyramid. I just don't need all those people that are looking for the food pyramid to look at this video, although that probably wouldn't be a bad idea. So here we are, a blank pyramid here, and let's go ahead and continue. All right, we have one of the lines filled in here on the ETF investment pyramid, and we got growth there on the left-hand side, and then there's some popular ETFs there, VTI, which is the total stock market index. We got VOO there, which is the S&P 500. We got VTSAX, which is basically another Vanguard. Admiral shares, it's actually a little bit more expensive to own than the VTI. So ITOT, just another flavor of the same thing, FXAIX, which I think is the Fidelity version of it. And all of these here are really solid investments, and they're great growth ETFs here. Now, this is not just, this is not inclusive of every ETF out there in the particular same category. There's other ETFs that you could put in the same category that are still solid plays as well. All right, now these are the most popular, I'd say. Now there might be a Schwab version as well, but these are probably the most popular ones that everybody knows of, and they're most notable, I should say. VTSAX, you always hear people talk about that, and that used to be a really top-notch one back when the Admiral shares used to be the SCHD. Now they kind of got replaced by the ETFs version, VTI, and it is what it is. So these are solid plays here. If you got 20, 30, 40 years until retirement, these are a great way to grow your portfolio. And it's just a one ETF investment. You could throw international or emerging markets in there to supplement this, but another option is you could throw VT, just VT, that's total stock market, that's world market, and that would encompass everything across the world, and that could fit down here as well. And I don't personally like that one, but it would be a good way to go as well, because you will cover all of the other countries around the world. And these are literally the cream of the crop right here. You invest in these, you're gonna always keep up with the market, and no matter what the market's doing, and you can always say, well, I'm performing as well as the market. And in general, you shouldn't be outperforming the market, because this is the market here. And just to let you know, VTI encompasses all of VOO. Just so you know, you shouldn't really own both at the same time in the same account. Now, if you want to own VOO in your retirement account and you want to own VTI in your taxable account, then that's fine. But I don't see the purpose of owning both in the same account. Pick your favorite flavor there, whether it's Vanguard or Fidelity or some other manufacturer or provider that provides the ETF, like ITOT, for example. Okay, so now we have growth covered there, and I think that this is a great way for most people to go when they're starting out. And even if you got even 10 years left, these wouldn't be a bad way to go. Now, you could supplement some of these ETFs here with some of the other ones I'm going to show up here. So let's go ahead and move on. All right, we filled in the next line there. We got growth/dividends. We got SCHD, we got VIG, DGRO, and we got VYM there. And those are growth/dividend ETFs, and most people probably listening in on this video have heard of these. Okay, now we got Vanguard in there, and we got Schwab, and we got some other providers there. DGRO, for example. So SCHD is one of the most top-notch dividend ETFs you can be in. DGRO is probably right after that. VYM is great as well. I used to invest quite heavily into VYM, and it didn't work quite how I wanted it to. Doesn't mean it won't work for you. You just have to see what kind of fits the bill for you, because all of these are not created equal. They have different holdings in there and different weighting for those holdings. You know, like VYM's like 400 or 500 stocks or something like that. SCHD is a lot less than that. And some are quite heavily weighted towards different things. And VYM, for example, when I was investing, it didn't have Apple, didn't have Microsoft, didn't have Starbucks, didn't have Realty Income, didn't have Home Depot. And maybe you want to be invested in those in your dividend ETF to be more diversified. So you need to really look at the holdings of these and see what one makes the sense for you. Now, these are most likely going to have a higher yield, dividend yield, than these ETFs down here. Okay, most of these down here are probably about 1% or so, maybe even less than that on the actual dividend. And these up here are probably about 2 to 3%, somewhere around that, you know, dividend. And most of these, I think actually every one of these, I think pays quarterly. There is some other options if you wanted to get paid monthly, like SPHD and I think DGWO or something like that, or it's DRWO. It's one of those two. But you are going to pay more in expense ratios for that. And honestly, SPHD is not the cream of the crop, and I would have tried to avoid it if I were you. So in general, these might have a little bit higher expense ratio than these top ETFs down at the bottom down here. These are going to be really low on the expense ratio. This might just be a slightly higher than these down here. So if you want some growth and some dividends, then these are a good way to go. You will get dividends out of some of these down here. It's just not going to be a lot. So if you want total growth, then go for these down at the bottom. If you want quite a bit of growth and you want some dividends, a decent yield there to kind of even replace or mimic a individual dividend portfolio, then these are a good choice up here, right? Instead of just investing in Procter & Gamble or Johnson & Johnson and AbbVie and Microsoft and Apple and HD and Caterpillar and 3M and all those stocks, which I have in my portfolio, by the way, which you will see here at the end of the video, you could invest in one of these dividend ETFs at the top right here or in this line right here, and that will replace your individual dividend stock portfolio. And that's not a bad way to go. Get paid quarterly for a low expense ratio, and everything's done for you. You don't have to, you know, manage 30, 35 stocks or anything like that. And you're going to get a lot of growth out of that. And in addition to that, most of these have a pretty darn good dividend CAGR, roughly about, anywhere from 5 to 10% that you're going to get a raise every single year on your dividend. So kind of, weigh the options there. You're going to get some growth out of these, but it's not going to grow as much as these down here. So, but you will get a little bit more dividends out of these up here. So, weigh those, Do you want to trade off a little bit more income in dividends for a little bit less growth, or do you want to have just all growth and just a little bit of dividends coming in? All right, we have the next line filled in here, and we got growth, income, and dividends. And I filled in DIVO, and KNG there, which is First Trust, I think is what it's by. And DIVO is top-notch. Let's just call it an income ETF, even though it's kind of a tweener. So DIVO basically has about 30 positions of really good companies in there. It's a managed ETF, and they also sell covered calls opportunistically against some of the positions. Sometimes they have a lot on, sometimes they don't have a lot on, sometimes they only have just maybe half the positions on or something like that. When they see the opportunity there, they do it. And DIVO had a fantastic year in 2021. It grew considerably, and it has a decent yield. The yield, I think, is about 4% or so, a little over 4%. And then you got KNG there, which is very similar to DIVO. where it is actually based off the aristocrats, and it's about 120 positions in there, and it's based off of the aristocrat index, and so that means 25 years of consecutive dividend increases. So that makes this a pretty darn good ETF as well. They target anywhere from 3 to 4% on the dividend. Now it does pay quarterly. DIVO pays monthly. And in KNG, they're doing covered calls against several positions in there. And I think it's actually only about up to 20% of the holdings themselves. So they are making some money off the covered calls, but it's not putting the whole portfolio at risk to being basically called away, and so you don't capitalize on the complete move up, right? So I haven't done a lot of videos on covered calls. I think I did a couple here and there, but in general, they're not doing covered calls against the whole entire portfolio, and that leaves room for the ETF to keep up with capital appreciation with the overall market. So that's sort of what DIVO does in a way. DIVO is just highly managed. And in KNG, obviously, we're going to consider that managed as well, just because they got to, put in and take out those aristocrats as they get taken off. They're just like, I think AT&T just came off the list after 36 years of raising up their dividend, and now they fell off the list. So that's the reason why it need to be managed. They need to take those out of the actual ETF, and they also need to run the covered calls against the positions. So these two up here are a good mix between growth, income. All right. Now, some of these could be, taxed differently. Some could be qualified dividends. Some could be return on capital. Some could be just NII, so net investment income, or qualified dividends. It could be a mix in there. So be aware of that. You will get some growth out of these. In addition to that, you will also get a dividend growth as well every single year. And DIVO is actually pretty darn good. So you will get basically a raise every single year on your dividends. So these are kind of a tweener, right? You want some dividends, but you want some, take advantage of those, the income coming in from the options, so the covered calls. And, when the market's going sideways or going down, they can still make money on those covered calls as long as the market doesn't go down too far, too fast. And then they will still make some money. But it might actually cause these to hold up a little bit better than these down here because they actually have the covered calls on. So the covered calls will lose value, which is a good thing when you're actually short the calls. And then if the market say drop 10%, they can just buy them back cheaper, and that's all income they can profit. So these here are not for everybody, but they're not a full-blown income ETF either. So they're kind of, they're a little bit defensive in a way. You get some great income out of it. You get some great growth out of it. You get some pretty darn good dividend CAGR out of them as well. And they're probably tax advantaged as well. Maybe not quite as much as these down here, because these should just be all straight long-term, all qualified dividends. All right, we're moving on here. We got Hedge, Income, and Growth up here. NUSI and JEPI. Okay, and those are some of my favorites right there. And we'll talk about my favorites, at the very last slide here, and also in my portfolio. So Hedge, Income, Growth. We got NUSI there, which is a income ETF. It's a highly managed ETF, and it's basically filled with the NASDAQ stocks, and then they run a caller strategy, which means they buy a put and they sell a call against the NDX cash settled NDX. And then JEPI here is a highly managed ETF as well it's made up of basically S&P 500 stocks. And it's not filled with all of the S&P 500 stocks. It could be filled with the reduced volatility stocks in the S&P 500, and they have the leeway of adding or taking out those stocks that they feel are a little bit lower volatility than the overall S&P 500 stocks. And then they sell basically about up to 15-20% of the portfolio against the cash settled SPX, and those are the ELNs. So the equity linked notes, and that's how they make the income. And I think the yield is roughly about 7 to 8% as we speak. So these are pretty good. These are hedged in my opinion. Definitely NUSI is hedged. It's got crash protection there. It is not a slow bleed protection. It's not a 10% down in a month protection. You will get some protection, I think, out of 10% in a month. But if it draws down 30% over 6 months, it's not going to really do too much for you. But you will still get income out of it, roughly about 7-8% of yield out of it. Most of these are return on capital. There could be some long-term and short-term capital gains in there as well. And these both pay monthly. So, and they do have a little bit higher expense ratio because you have to understand that they are doing options and that requires work. So they're going to get paid for that. And the same thing with at least DIVO. Haven't looked, actually, I think K&G is about 0.75 as well. So all of these up here are doing options, and guess what? That requires a little bit of work. Not to mention that 3 of these pay monthly, and that costs a little bit more as well. So you will pay a little bit more in expense ratio, but you're getting made up with that, with them doing the work for you. You could do the same strategy. I know it's very difficult to duplicate what they're doing because they're doing against the cash settled NDX or SPX. So it's very tough to kind of, own everything that DIVO owned, which is, $300,000-$400,000 worth of stocks, and then running the cover calls against it. And the same thing with the NUSI and JEPI. It's very tough to duplicate what they're doing because they own the stocks and then they do the options against the cash settled. All right, so you're going to get growth out of these, at least JEPI. Growth maybe in NUSI is not quite there because that one is hedged more than JEPI. Now, JEPI is a great, I think it's a great mix, I'd say. Good growth, good income, and it's also hedged in a way because it has lower volatility stocks in there. NUSI is a little bit more of a traditional hedge there. It has a collar strategy which has a protective put in it. So it's hedged more than JEPI, but you're going to get maybe a little bit of growth out of that, very little growth, but you will get income out of that. So I kind of put these in the same category because they're hedged, just hedged in a different way, right? JEPI's just got lower volatility stocks. All right, we filled in the very last top of the pyramid up there, and that says income. We got QYLD, we got RYLD, and we got XYLD up there, which are the Global X income funds. And the QYLD is based on the NASDAQ. We got RYLD is based on the Russell. And we have the XYLD, which is based on the S&P 500. Every one of these is not managed, in my opinion. They're not really managed. And they also just run a rules-based option strategy. So they're running covered calls. And they're strictly doing covered calls. And so you're just going to straight get income out of those. Those are not hedged at all. And you're not going to get any growth out of these, in my opinion, at all. So they're not hedged, and you're not going to get growth, but you will get income out of these. And if that's what you're looking for, these are the 3 for you. Now, they're not all created equal, right? RYLD had a pretty rough year. QYLD had a pretty rough year. And then you got XYLD, which actually had a better year than the other 2. It held up a lot better than QYLD did. So the NASDAQ has sold off a lot more than the S&P 500 the last several weeks. That's the reason why QYLD has sold off more than XYLD. So these are income ETFs. You shouldn't really be in these if you're looking for growth and you're looking for a hedge, because those are not hedged and there's no growth. All right, now that we've kind of gone through the ETF investment pyramid, let's talk about kind of who should be investing in what, right? Now, if you're, got a lot of time left until you retire, then this bottom rung down here should be what you should be investing in. Okay, now if you want to throw a couple of these here in the second rung, the growth and dividends, just to keep you a little bit motivated because you like to see that income coming in, then these are another option up here. You could supplement or replace these with that. And then when you get up to this next category up here, if you want to have more income, you want growth in there, you want a monthly pair in DIVO, and you want, let's just say you wanted to have a dividend portfolio, you wanted to run covered calls against your dividend portfolio, all the individual positions, you could replace that strategy with DIVO alone, okay, or, K&G, for example. Because I used to do it, and it's very difficult to do because things just run up and they get called away, and then they generate a taxable event, or or you miss out on the upside and all that. So it's just easier to let this ETF or these ETFs do that for you. So take that into consideration. Plus, you have to have 100 shares for every one of your positions to run a covered call against them. So that costs a lot to have a bunch of positions with 100 shares each, right? So in my opinion, If you got a lot of time left until retirement, these really, anything from this triangle right here and above really probably shouldn't be anything you're in, really. There might be a couple of caveats there, but you really should be staying in these two bottom triangles down here. And then you got NUSI and JEPI, which are, you know, a little bit of a hedge, but a little bit of growth. And then you got income. And if you're getting close to retirement, and you know you're a couple years out, then you could transition some capital to those two up there if you need the income. Now if you don't need the income, then it's just better to stay in the stuff down in the bottom two, okay, because you're going to trade growth, obviously, and so you need to really make that decision on your own. If you want kind of like a bond replacement, and that's loosely said, NUSI could be a bond replacement, at least for right now. It's kind of my bond replacement, I should say, because I'm not a big bond fan. But so, you know, if you're a year out or 2 years out, then you could stick some capital into these and to protect yourself a little bit while you get income. Now, if you have a $10 million portfolio and you only need $100,000 to live off of, then, you know, why do you even need to screw around with these, you know, top three triangles up here at all? You know what I mean? But everybody's different. Everybody's in a different bucket, and it's hard to make a video that encompasses everybody because everybody's in a different situation. And that brings us to the top up here. Who should be invested in RYLD, XYLD, and QYLD? Now, I do own all three of those, by the way, but to me, if you've ever seen the food pyramid, guess what it says at the very top? It says use sparingly. And it's no different here. So what they mean in the food pyramid is that's where all your bad fats are, and that's where all of your sugar is. Well, think of these as your bad fats and your bad sugar. Use sparingly because you're going to really limit the growth of your portfolio, not to mention like QYLD, for example, has been a declining asset for several years now. As long as you reinvest some of the capital that you get paid back in that ETF, then it might, you know, actually probably be okay. But, you know, if you really need the income, then, you know, let's just say you're 65 years old, you have, $700,000 and that's all you've got, and you need to make it last for quite a while, then maybe QYLD is the right answer for you. But for people that are young, you shouldn't be investing heavily in these. Use sparingly because you're really limiting the upside of your portfolio, and there's no hedge there, and it's strictly income. Most of it, I think, is all return on capital, which is actually pretty good for a taxable account. But they're not for everybody, so you kind of need to weigh those options for yourself. As I said, I tell you, we look at my portfolio. So this is my portfolio here as of Thursday, January 20th. I got 85 days left until I retire, and I'm putting my notice in basically in about a month and a half or so. And then I'm actually going to retire on April 15th. And then I'm going to go hike the Appalachian Trail, and that's the first thing I'm going to do. So I do run another channel, and that's Hidden Off Grid. I'd appreciate it if you go ahead and support that channel, because that channel, I'll be making updates on that channel after I retire and doing videos on the Appalachian Trail. Not to mention, I'll be making other videos over there kind of related to healthcare and, living off the portfolio and different stuff that I don't share on this channel, even though I will be doing healthcare videos on this channel as well. But anyways, the link is at the top right over there to support that channel. I'd appreciate it if you do. Today was a bad day in the market, down $5,100. Let's go ahead and look at my current portfolio and just look at the positions in here. I told you I basically own a lot of those ETFs that are in the list. And there's SCHD right there. I'm going to be continuing to build that position out. Once I retire, there'll be a lot more capital going into that. And then we got QQQ right here, which will be a lot more capital in that as well. I'm not going to share the whole strategy. Please take a look at a previous video at the top right over here if you want to look at the strategy, because I'll be using cover calls against, and actually the wheel strategy in general, to get into some stuff. And I don't want to talk about in this video because I want to try to keep this video shorter. There's all my individual positions right there. And like I said, I did have quite a bit of individual positions, about 30, 35 positions. And now I'm down to about 20 odd positions, individual stocks there. I used to have 100 shares of a lot of these and running my own covered calls, and I just, stopped that strategy. And then we scroll down here. Here is all of the income ETFs right here. We got QYLD right here. We got XYLD right here. We got NUSI right there. We got JEPI right here. We have DIVO. So in pretty much a lot of those in that list there. And I'm kind of keeping the QYLD and the XYLD limited at about $50,000. NUSI roughly about $150,000. And then JEPI and DIVO will be the largest ETFs in my portfolio with roughly about $180,000 to $210,000 each as I continue to build this out. So scrolling on over here, just take a look at a different page here, and just to kind of show you what the actual allocation's looking like. This is kind of what the allocation is looking like right here. And I did a whole video on this particular page, and I'll link that at the top right over here if you're interested, take a look at that video, because I don't want to talk about it to nauseam in this video. But I really want to just illustrate that I kind of have a bucket strategy. And so actually I can illustrate it better over here. So I can illustrate the bucket strategy better over here because I own NUSI, JEPI, QYLD, XYLD, and RYLD. And then I own DIVO and SCHD. And now my plan is obviously I'm generating roughly, what was that, $8,000 of income off of my strategy, including doing cash secured puts and all that in a different account. And my plan is I don't need that amount of money to live off of. So what I'll do is I'll reinvest a lot of that capital back into NUSI and JEPI and DIVO until they get built out to where that I want them to be built out to. And then once those get built out, I have enough income coming in, then guess what? I'll roll it down to SCHD and start building that out. As SCHD grows, I get older. And, you know, when I get older, there's a lot less you have to figure out. Plus the portfolio should grow. Then what I'll start doing is I'll start rolling capital out of some of these ETFs up here, like the income, maybe even some capital that's actually in the position, and roll it into like VTI or VOO. So I'm going to keep rolling it down. Right? And eventually I want to get rid of QYLD, XYLD, and RYLD, and then kind of reduce the NUSI down and kind of just reduce a lot of these income ETFs down as the portfolio continues to grow. But when I retire, I don't know exactly how much capital I'm going to need. Actually, I think the portfolio provides more than I actually need. But, you know, I mean, 10 years from now, the portfolio should be a lot larger, and I can get out of some of these little bit riskier plays like, you know, QYLD, RYLD, and XYLD for more solid positions like SCHD and VTI and or VOO. So here's my M1 account, and just to show you that I do own those other two there. So I got RYLD right there, QQQM, and BST. So I basically own every one of those Global X funds against every one of those indexes. If you're not aware, M1 is doing the deal where you get $50 for free if you open an account and deposit $100. I get $50, you get $50. It goes all the way till March 31st, and it's a hell of a deal, 50% return on your money. Go ahead and see the first pinned comment for the link. So that wraps up this video. Let me know what you think of this strategy and what you think of these income ETF pyramid here. And I'd appreciate it if you do all the YouTube stuff like and subscribe, and go ahead and set that bell notification. Let me know if you have any comments, questions, or concerns, and we'll see you next video. Thanks for watching.